thus far we have completed the components of financial system, right? We have started financial services, financial markets, financial assets or instruments. So today we'll be dealing with the last component, and which is very vital in the development of our economy, called as financial institutions. Let's look at the meaning. Financial institution is engaged in the business of dealing with financial and monetary transactions such as deposits, loan, investment, and currency exchange. Now, when I'm talking about financial institution, it's not just about banks that is involved into accepting deposits and lending loans. Financial institution deals with a lot more other broad kind of financial services. It can be investment advisory, it can be dealing with currency exchange, right? Now, next line, as we see, financial institutions encompasses a broad range of business operations. So it's not just about banks, but it's more than that. It's a broad range of business operations within the financial services sector, which includes banks, trust companies, insurance companies, brokerage firms, and investment dealers. These are the few various investment institutions that we have in our economy. Hope you've understood the meaning of financial institution. Let's today look at the features of financial institution. What does financial institution do, or what is their functions or characteristics? First one, financial institutions are the backbone of the economy. It is considered very important for the development of financial services in the country. Now, to control the entire money flow in the economy, the inflow of the money or the cash flow of the money, everything has to flow through a one common mode, that is financial institution. Now, that is why it is termed as the one of the vital element in the development of our Indian economy. It also advises the customers or people on how to deal with equity and other securities bought and sold in the market. They don't only take care of the money or the money flow in the economy, but they also give advisory services or advices as investment channels, which is the best avenue to invest, or which is the avenue which has high risk or medium risk or low risk. Okay, in terms of instruments like equity, derivatives, bonds, etc. All these instruments are bought and sold in the market. So financial institutions also advises or also lays down instructions or instructions to people who would like to invest their savings into financial assets or instruments. It helps to improve decision making because it follows a systematic approach to calculate all the risk and rewards. Now remember, these various financial institutions that we have follows a systematic approach. Now, if you're an investor looking for an investment avenue, you would first do your basic research, right? Now, even let's not go to investment, come back to a basic level. If you have to buy a phone, a smartphone, the basic thing, you as a student or anybody would do a basic research, right? Which is the best phone available within my budget? What are the features of the phone? Which company is better, etc. You do your basic research just before purchasing a certain smartphone. That's for your personal usage. Now, for companies or for financial institution, it is equally important as to how am I directing the savings of people into various investment avenues. So you as an investor, before investing, you need to follow a systematic approach. Okay, what are the areas of investment? Is it bank? Is it post office savings, or is it derivatives or bond market or government bonds, etc.? Where is it that I need to invest my money, and how is the risk associated with each of this investment avenue? I need to calculate my risk and also be calculating my reward. Reward is nothing but your return on your investment. So I need to understand both the perspective. How much risk is there in each investment avenue, and also how much reward or return does the investment avenue guarantee. Is that clear? Next, due to their pivotal role in the development and the growth of the economy, the government regulates these institutions through a central bank, insurance regulators, pension fund regulators, and so on. Now, we just got to know how important financial institutions are for the growth and development of the economy. Now, here we'll be studying. Now, yes, they are important for growth, but what are the channels through which the institutions work? Some through the central bank, some through insurance, some through pension, some through commercial banks, some through mutual funds, etc. All these examples that I've given you here are together called as financial institutions. They might operate in a different sector like bank or mutual fund, insurance, okay, government bonds. They operate in different sectors, but all together they all work towards the development and growth of our economy. Let's look at the first one, regulation of monetary supply, which is a very vital and very prominent factor for any economy, irrespective it's a underdeveloped, developing or developed economy. Regulation of monetary supply is important, because if there is too much money in the economy, it might tend to wastage of funds, or it may tend to over usage of funds. On the other side, if there is reduction or scarcity of funds available in the economy, it does not satisfy or meet the needs of people. Okay, it should not be too less, neither too much, the monetary supply in the economy. Therefore, it is the financial institutions through the form of what? RBI, Central Bank of India, is Reserve Bank of India. So RBI help in regulating the monetary supply in the economy. They do it to maintain stability and control inflation. As we discussed earlier, now in order to have more money flow in the market, okay, increase the flow of money in the market, what does the RBI do? It reduces the interest rate on the loan. Now, all those people or students or institutions or people who would like to take the loan, looking at the lesser interest rate or lower interest rate, they would all rush to take loan. Therefore, the money is flowing from the bank to the people or to the institution. So, there is more money flow in the market. On the other side, if RBI wants to control the money supply or the monetary supply, automatically it is going to increase the interest rate. You got it? So, here now what happens is, people, if they want to take a loan, just by looking at the high interest rate, they would refuse to take the loan, or they would postpone the idea of taking loan, because they cannot afford to pay back so much of interest as in looking at the interest rate displayed by the respective commercial banks. Okay, so one of the major important pivotal role of financial institution is regulation of monetary supply. Next up is banking services. As I told, banking institution like commercial bank help their customers by providing savings and deposit services. Now, it's not just people, when initially banks were introduced, or banking, the concept of banking started in India, it was just about deposit. We are going to collect money from the public and pay interest on those deposits. And then they started giving out loans to only business people. And then now, over the years, it has become from only business loan, or loan means only for the purpose of business activities. Now loans are available for education, loans are available for purchase of an asset like a car loan, right, a bike loan, or a personal loan, educational loan, etc. So banks itself have grown over providing alternative services to their customers. Next is insurance services. So if I say insurance, the quick word that has to come to your mind is overcome risk or cover up loss. Okay, financial institutions like insurance companies help to mobilize savings and investment in productive activities. So another area of financial institutions are insurance services. Insurance services, what do? They're going to collect EMIs from the client or from the customers, and they take over the customer risk upon themselves. That way, when customer is facing a loss, let's say the godown or the office is on fire, or the goods is stolen, or the goods have been by fire destroyed, etc., there is a loss for the customer, there is a loss for the company. The insurance company is going to cover up for that loss. Okay, the insurance company is going to cover up with that loss. So insurance company mobilize savings and investment in productive activities. So I don't have to wait until until I lose something. Instead, through the financial institution of insurance services, I can start saving or start keeping a part of my savings in the form of insurance companies or insurance services. So that way, tomorrow when I quickly face a loss or a downfall with my company, or fire accident, any destruction in my godown, etc., I do not have to worry where to arrange money, how do I cover up this loss, because I already have taken up a insurance policy which will take care of my loss, or how to manage my loss. Is that clear? The second services are banking services and insurance services. Moving on to the next one, financial institutions also help in financing the small and medium scale enterprises. Now, if you remember this SMSEs, it's called in short SMSEs, which is called small, medium and large scale enterprises. Okay, basically it is industries, small industries, medium scale industries and large scale industries. These are in short called as by government SMSE. Now the government of India had recently launched a concept called as Mudra, okay, which specifically aims at giving financial assistance to these small or medium scale industries to develop, or to provide finance for them to effectively carry on their business activities. Now let's say these industries are working on a small scale, but these goods are exported to other country. Okay, from India it's being exported. So that way government of India is going to give more financial assistance and recognition, and also maybe tax incentives, or maybe they even have a tax free industries. Okay, so whatever profits or whatever items or products they want to export it to other countries are absolutely tax free. Okay, it is just an encouragement from the government for the industries to continue their production or their business activities. Got it? So financial institutions help small and medium scale enterprises set up themselves in their initial days of business. They provide long term as well as short term funds to these companies. The long term fund helps them in formation of capital, and short term funds help their day to day needs of working capital. Last class, did we look at what is fixed capital and what is working capital? Where do we get our fixed capital from? Capital market. Remember, the primary and the secondary market, the stock market, IPO, all these we came across, right? That is what I'm talking about, fixed capital. It helps in forming the capital for the business to initiate, to start the business. Moving on, short-term capital or short-term funds is what am I talking about? The working capital. Where do I raise my working capital from? The money market. Remember, money market is a part of my financial market. We read about certificate of deposit, commercial bills, treasury bills, commercial paper, intercorporate deposits, right? Now, all these are the medium for which the small and the medium scale industries procure working capital, or otherwise called as short term funds. Is that clear? So this is the third benefit or the third feature of financial institution. Next is capital formation. Financial institutions help in capital formation, that is, increase in capital stock like plant, machinery, tools, equipment, buildings, means of transport and communication. Now here I am talking about not just procuring or forming capital, but using this capital, what am I able to afford or what am I able to purchase? For certain companies who are good at ideas, who are good at entrepreneurs, right? Have great business ideas, but the reason they cannot convert those business ideas into a reality is because they lack finances, because they lack that technology. So we as financial institution provide them that financial assistance so that they can procure capital in the form of machinery, in the form of equipment, in the form of buildings, means of transport and communication. Is that clear? So it is another form that is provided by the financial institution by giving them funds so that they can afford all these assets or all these capital. Why is it called as capital and asset? Because I am using this asset. It's a one-time investment, but the benefit derived from that asset is beyond one accounting year or one financial year. Am I going to replace my asset or equipment every single year? Definitely no. It's a one-time huge investment, but the benefit that I'm going to enjoy out of that asset is to be more than one financial year. That's why it's called as capital or it's called as a fixed asset. Next one is pension fund services. So this is another category of financial institution where through their kinds of investment plans help the individual in planning their retirement. So one such investment option is a pension fund. It is one of the best options, I would say, under the financial institution category, pension fund. Because so often just at the period of service we have regular income called as salary, right? What happens beyond retirement? Once the person retires, there's no income. So how are going to the people survive? How are they going to pay their rent or pay their bills or pay their expenses? It's a question mark. So that's when the government introduced a concept called as pension fund. What is this pension fund? During your service period, have you heard about the provident fund, right? Goes with the same. So during the service period of any employee, right from the day he has joined the company or joined an institution, before he gets his final paycheck, that is his salary, the organization is going to deduct maybe 5% of his complete pay or maybe 3% of his complete pay. So he's going to cut from this pay and then give him the remaining salary in hand. Got it? So this little money that the organization is deducting, organization also will add up some more money to it and keep accumulating it until that person exits the company. Let's say that the employee continues to work for, let's say, 30 years in the same institution or organization. So that 3% every month for the next 30 years, the company has accumulated the funds in the name of the employee. When will the employee be able to withdraw this money or enjoy this money is once the employee retires from his work. Okay, so either when can an employee retire? Either when he attains the age of 60 years, or if he wants before his retirement age, if he wants to retire, that is he can take a VRS, voluntary retirement service. So then he is eligible to withdraw that pension fund. Can he withdraw in one shot? Not completely, but maybe 60% he can withdraw in one shot. Otherwise, government will start paying him pension like salary, a small amount after retirement every single month. Now, this entire arrangement is done by financial institutions. So, we have looked at various institutions today or various categories of financial institution, how the money supply is being controlled, in what ways, under what circumstances, either through central banks, through commercial banks, in insurance services, capital formation, small and medium scale industries, and pension fund services. Got it? So we have covered what is the meaning of Financial institution. What are the features of financial institutions? Regulation of monetary supply, banking services, insurance services, financing the small and medium scale enterprises, capital formation and pension fund services. So next class will be looking at the classification of financial institutions.